talking about countries which, over a period of time, being embedded in an unequal social order, are characterized by these chronic trade and current account deficits. Um, they have to basically rely on debt in substantial measure because there's only a certain amount of supply side determined flows of foreign direct investment to these countries. So they have to rely on debt, which in the early days, of course, used to be predominantly bilateral and multilateral debt because developing countries or low and middle income countries were shunned by international finance, private international finance. So they took on this debt, and over a period of time, if you have chronic deficits, you obviously accumulate debt to a level where you're borrowing to service new debt to a certain extent, and that puts you at different points of time, different parts of the world, into a situation in which you're trapped in what is an unsustainable external debt situation. Now, what we do know is that if you, as I said, if you take the period prior to the 80s, there was some kind of a self-correcting mechanism in the global order. And that self-correcting mechanism essentially consisted in the fact that both bilateral and multilateral flows of capital to developing countries, so if you exclude private foreign direct investment, were completely determined from the supply side. They were determined by the strategic concerns of the so-called donor countries. And there was a maximum to which these countries, as we know, in terms of the share of ODA, GNP, and so on, or GNI, being much less than the zero point 0.7, that there was a maximum which was available, which was determined from the supply side. So if you allow your current account deficit to go beyond a certain level, then you obviously are not in a position to be able to obtain the finance to cover that deficit, and which basically means that you had a problem, you needed emergency financing. So this was, in some sense, not necessarily a good thing because it's always the debtor countries which had to adjust, but it basically was some kind of a self-correcting mechanism in this unequal order. Now we know that changed. That changed in the 1980s. It changed first because of the liquidity which came from the oil shocks. It changed because of the fact that the United States had begun to behave like it had a mint in its backyard. It had no national budget constraint because the dollar was good as gold. It undertook expenditures which actually allowed it to export capital, even when it was running current account deficits. It allowed it to police the world. It allowed it to fight the Vietnam War, et cetera, and put this huge volume of liquidity into the international system. And finally, when the baby boomer generation had come into the market, they basically had to save for retirement, and therefore you had the pension funds, etc., had accumulated a significant amount of capital. And all of that capital now was looking for new destinations, and that's where the so-called emerging markets were discovered. There are aspects of this restructuring which I want to focus on very briefly. One is that the IMF becomes the principal mediator in the more recent times. When we had this huge increase in the number of defaults, I think 14 defaults between 2020 and the first quarter of 2023, as compared to 19 defaults, according to Fitch, over a period of something like 15 years before that. So you have this serious crisis. The IMF emerges as the principal mediator, but it comes in late. That's not because of the fact that the IMF wakes up late. I think it's partly because of the fact that if you want to get governments to actually do what you think that they should do in a situation of crisis, you have to push them into a state of desperation in order to be able to get them to actually, prior to even a staff level agreement and post a staff level agreement through the basis of that agreement, even after you get a staff level agreement, however, the issue is not even, the first stage is not even resolved because you need board sanction. And the sequencing has basically meant that in the interim between the staff level agreement and the board sanction, bilateral creditors, the principal bilateral creditors, must be approached by the debtor country government, and you actually have to work out financing assurances in keeping with the DSA. So the IMF decides what needs to be done. It partly decides it on the basis of a document whose method as well as its content is not all that transparent. And it basically states what needs to be actually contributed by different sets of creditors. And you end up with a situation in which you first need to get the bilateral creditors to provide these financing assurances, which puts huge pressure on them. So if China doesn't do it, you say, oh, look, China is delaying everything, holding back the resolution, etc. So you have the sequencing. And you finally, of course, have the board level agreement. But even after you have the board level agreement and the financing assurances, you need to get a written an agreement on the part of the bilateral creditors Multilateral creditors make some promise, but they actually don't take any restructuring, no haircuts, because they lose the preferred creditor status, they argue. And finally, of course, you need to actually have some kind of an agreement with the private creditors, which, as we know, never really comes. If you ask ourselves what exactly is the IMF trying to do through its policies, it claims it's trying to revive investor confidence. So you have you have economic contraction, you have domestic savers required to bail in the debtor by accepting domestic debt restructuring, which has become now common. Of course, Zambia didn't have it, but Ghana had it, Sri Lanka had it. Both of them have implemented it in different forms. These policies do not get to two things. One is the fact that you are chronically deficit countries and therefore need policy space to be able to correct that, unless otherwise you're going to have the same thing. And the second thing is you do not allow any capital controls of significance. The restructuring conundrum begins with the fact that, of course, that the multilateral creditors wouldn't take a haircut because it's very clear that you need a haircut. And if you need a haircut, then there are three sets out there: the bilaterals, the multilaterals, and the private creditors, combination of commercial banks and bondholders and others. But one set don't do this. And that's quite important because of the fact that as a consequence of the aid fatigue of the developed industrial nations, a large part of the flow of what could be called official credit from the advanced market economy nations essentially goes through multilateral channels. There's very little they have in terms of the bilateral kitty. The bilateral kitty, of course, in most cases, not Ghana, but Zambia definitely, Sri Lanka definitely, is dominated by China. So you really are saying that there is now a player out there who doesn't have influence on the principal interlocutor or the mediator, which is the IMF, which has to accept what it puts into its DSA and has to take much of the burden, because in practice, we know that what is written into that DSA is a very small haircut for private creditors when compared to what the market is demanding. If you actually look at what's the prices at which those bonds, those stressed bonds, let us say, are trading in private markets, secondary markets globally. So you basically want to see China as being the agency which will take a large part of the burden in order to be able to ensure this. Focusing on aggregate debt, there is a total amount of, let's say, public debt to GDP, fiscal deficit to GDP, etc., without discriminating between external and domestic debt is diversionary because of the fact that you're actually diverting attention from the fact that the reason you have the external debt problem is because of the nature of the international system. But as far as domestic credit is concerned, you're basically saying that this is credit which has to be repaid in a currency over which the local government and the central bank has control. But the local government and the central bank, everybody knows, doesn't have control over hard currency, particularly in countries which are not reserve currency countries. So therefore, they're two completely different problems requiring very different ways of resolution. But by combining them, since it is inevitably going to be true that domestic debt is going to be a dominant share of total debt of the sovereign, you're going to actually divert attention from what nearly needs to be done. So if you're talking about an alternative template, of course, then this is being done at the expense of whom? Of pension funds, and therefore those who saved for their pensions, of commercial banks who are going to have problem providing credit subsequently, and so on and so forth. So you're going to have an additional dose of austerity through the DDR mechanism in order to be able to proceed. Negotiations must be based on some transparent estimates of haircuts, which must be based on a multilaterally defined idea of comparability of treatment. The IMF in its DSA cannot implicitly have a definition of comparability of treatment. Evidence? Look at the level of haircuts. Sri Lanka, it was pointed out, 30% haircut. What is 30% haircut when Sri Lankan bonds were trading at 40 cents to a dollar? That is 60%. Already the market is defined for you. So it's not a neutral pair. It's actually like it was in the case of the role of the Treasury in the AD bonds. The IMF is now the front manager to actually ensure that the private creditors get off with a pretty good deal after having taken out substantial sums on the basis of their sort of risk combined interest premium. But still, these private creditors are intransigent, so including the commercial banks and bondholders. So we need to have, like the New York law, like what might happen but we need to go further than that. We need to say that if you're going to reform the international financial system, you're not just going to reform the IMF and the World Bank. We want the IMF out. They are not neutral technocratic players. Move that into the UN, as it has been suggested. But we also need the advanced economies as part of the reform of the IFA to change the laws so that you can actually impose. You should be able to force the private creditors to come to the table and accept what is not an IMF determined haircut, but an haircut determined on the basis of a transparent understanding of what constitutes comparability of treatment by a multilateral body, which must be under the auspices of an organization like the UN. We also know that even if you get to all of this, you're really going to have an interim when there has to be more liquidity which goes to these countries because they're not going to immediately be able to adjust. Okay. So, maybe purpose specific SDRs. You say that if a country actually goes through a restructuring negotiation through this more democratic and participative channel, then there must be an automatic issue or there must be a kitty of SDRs from which they issued a certain amount of SDRs over the term of the restructuring period. Not the IMF's, let's say, what was it, 3 billion in a context of 51 billion debt in Sri Lanka? Not like that. You actually work out a reasonable sum of cheap liquidity, which is available during the interim. We are really talking about the ambience of an unequal post-colonial societies where the desire to consume, particularly of the elite, and the capacity to produce is low. That's why partly you have these chronic deficits. So we need to get into a situation of a medium-term strategy, which is where I come to an end, which shifts attention from the proximate factors that precipitated the post-pandemic crisis, for example. That is, you want to say that, oh, it's the pandemic, it's the Ukraine invasion, it's the increase in interest rates. No, it's a long embedded inequality, which leads to chronic deficits, which have to be financed with debt, which then requires you to borrow more to finance the repayments on that debt. So therefore, we have to limit import dependence. We have to restore domestic space, which allows you to do this. You must impose rules that limit external liability. It's not enough to plug into global value chains. That doesn't give you value addition of any significance, but you actually need to have a proper export-based strategy where you build your national champions and generate value addition and employment. And final thing is this can't be done alone. You need regional markets. You need South-South trade, particularly for smaller countries. Which are the countries which are most vulnerable? You need not monitored and with surveillance from the IMF, like the Chiang Mai initiative, but with your own mechanisms of actually ensuring that funds are used. And finally, maybe no single country in this kind of an unequal world where these powerful brokers, backed by these powerful governments, it's not going to happen. So finally, well, if you want to be nice, you can say we need debtors coalitions. I think we need debtors cartels. We need a cartel which basically says you either take what we offer through our template, which we think is reasonable, or let's see where the crisis takes you, your banks, your financial institutions, and of course, us as well.